Imagine a sudden fire raging in the unit next door. Or maybe a break-in while you're away.
Yeah.
Or even just something seemingly small, like a leaky pipe from the apartment upstairs causing, major water damage.
Happens all the time.
Right. Now, take a second and picture everything you own. Your brand new laptop, your furniture you spent ages picking out, every single piece of clothing, your books, maybe like your grandmother's jewelry, even your toothbrush.
Mm-hmm.
Could you actually afford to replace all of that tomorrow if it was gone, destroyed, or stolen?
That's the question, isn't it?
And most renters, it's a really common and honestly costly mistake. They just kind of assume their landlord's insurance has them covered.
Yeah, that's a huge misconception.
But here's the absolute critical difference.
Right.
Their policy, it protects the building, the actual structure, the walls, the roof. It does not protect your personal stuff inside that building.
Nope.
And it doesn't protect you from certain liabilities either.
That misunderstanding is incredibly, incredibly common. And it just leaves renters so financially vulnerable. They often don't really get it until disaster strikes.
Exactly.
It's the kind of thing that can turn, an unfortunate event into a truly devastating financial crisis.
And that's precisely what this deep dive is all about today. We're going to really unpack renters insurance here in the U.S.
Yep.
We're going to figure out not just what it is, but why it's actually essential. We'll peel back the layers on what specific protection it really gives you, demystify what it usually costs, and spoiler alert, it's probably way less than you think.
Almost certainly.
We'll guide you on how to make sure you're getting the right coverage, tailored to your life. And crucially, walk through what you actually do if you ever face a situation where you need to file a claim.
Yeah, the practical steps.
We've pulled together a whole bunch of sources, giving us a really comprehensive sort of boots on the ground look at all of this, from the nitty-gritty of coverages and costs to avoiding those common mistakes people stumble into and navigating that whole claims process.
Our mission here is really just to equip you with the practical knowledge you need so you can protect your stuff, gain some real peace of mind, and do it without feeling totally overwhelmed by all the insurance jargon.
Think of us as your guides, basically, helping you map out that path to protection so you're not left facing, potential financial ruin if something unexpected happens in your rented home.
Exactly.
So let's dive right in. Let's tackle that fundamental question, the absolute core of the why. Why isn't your landlord's insurance policy enough for you as a renter?
Well, it really just boils down to who owns what. Simple as that. Your landlord's insurance policy could be a dwelling fire policy, maybe a commercial property policy, depending on the building. It's designed purely to protect their investment. Their building. The bricks and mortar, the wood framing, the roof, foundation, built-in fixtures. Maybe even like the washing machines in a shared laundry room, if the landlord owns them. Their policy covers the physical structure and their property within it.
Okay, but everything I bring into that space, my couch, my clothes, my computer, my dishes, all my decorations.
Exactly, all of that. That's your personal property.
Yeah.
And it is explicitly not covered by the landlord's insurance.
Okay.
Their policy, it just stops at the structure. So if a fire burns down the building, sure, their insurance pays to rebuild the building, but it pays absolutely nothing towards replacing your burnt sofa, your smoke-damaged clothes, or your melted TV.
Wow. Okay. And the risks we're talking about, they aren't just those massive, headline-grabbing disasters, are they? Like big fires or huge storms are possibilities, sure, but everyday stuff can cause serious loss too.
Oh, absolutely. Damage to your personal property can come from a surprisingly wide range of events.
Yeah.
The insurance word is perils, and a lot of them are totally outside your control, especially, like you said, when you're living in a multi-unit building.
Yeah.
Our sources point to common things like fire and smoke damage, obviously.
Yeah.
Vandalism, theft or burglary someone breaks in, damage from wind and hail during bad storms, and a really big one for renters.
Right now?
Water damage.
Oh, yeah. Water damage seems huge.
It is huge.
Yeah.
Because it can come from so many places, right? A leaky pipe in your own apartment, sure. But also a pipe bursting inside a wall, a faulty water heater, and this is key, water damage coming from the unit above you or next to you.
That point about being in a shared building is so important. A fire starts upstairs, a pipe bursts 2 floors up, maybe the neighbor just lets their bathtub overflow.
Yep.
All of that can wreck your place and your stuff, even if you've done absolutely nothing wrong.
Precisely. And without renter's insurance, if any of those covered events happen, you are personally on the hook for the entire cost of replacing everything that gets damaged or destroyed.
Everything.
Everything. Think about how much that adds up. Start tallying the cost of a new couch, dining table, chairs, your bed, mattress, your entire wardrobe, clothes, shoes, everything. Your computer, TV, maybe a gaming console, kitchen appliances, pots, pans, dishes, towels, bedding, books, all your hobby stuff.
Wow.
It shoots up into the tens of thousands of dollars really, really quickly, even for just a moderately furnished place.
And it's not just the big ticket items either, is it? I mean, replacing all your sheets, towels, those little kitchen gadgets, cleaning supplies, even toiletries, buying all that at once adds up incredibly fast.
It really, really does. The financial burden can be absolutely immense. And, beyond just the money, there's the emotional stress, the hardship of losing personal things, especially items with sentimental value, photos, family heirlooms, gifts you cherish.
Yeah.
Renter's insurance helps cushion that blow, both financially and emotionally. It gives you the funds to help you recover and rebuild.
So you can actually focus on getting back on your feet.
Exactly. Instead of being to provide that, intangible but vital peace of mind. Knowing your financial security isn't just hanging by a thread based on the building's pipes or your neighbor's cooking habits.
And increasingly, it's not just a smart financial move anymore, right? It's actually becoming a requirement in many leases.
Oh, definitely. More and more landlords and apartment complexes now require tenants to show proof of renter's insurance before they'll even let you sign or renew a lease.
Why is that? Is it just about our stuff?
Well, there are a couple of reasons from their perspective. First, they want to know you have the means to replace your belongings and find somewhere else to live temporarily if needed, so you're not left destitute and unable to pay rent after a disaster.
Makes sense.
But honestly, a major driver for them requiring it is something we're about to get into, the liability coverage part. Landlords want that assurance that if you, the tenant, are somehow responsible for damaging the building itself, or, critically, for causing injury to someone else on the property, that you have insurance coverage to handle those potential claims. It gives them an extra layer of protection against potential lawsuits.
Okay, so the why is crystal clear. Your stuff, your potential liability, that's your responsibility, not the landlord's. So now let's really dig into the what. What does a typical renter's insurance policy actually cover? The sources seem to point to three main pillars.
That's right. These are the core components, really designed to cover the main risks you face as a renter. The first pillar is personal property coverage. You might see this called Coverage C in policy documents sometimes. If you see that, this is what they're talking about.
And personal property is just the insurance way of saying all my stuff, everything I own inside my apartment.
Pretty much, yeah.
Yeah.
It's basically everything that would fall out if you could somehow, turn the building upside down and shake it. So all your electronics, computers, TVs, stereos, game systems, smart speakers, your furniture, sofas, chairs, tables, beds, all your clothes, books, jewelry, sports gear, kitchen stuff, decorations, toiletries, anything that belongs to you that isn't physically part of the building.
Got it. And this part of the policy pays if my belongings get damaged or stolen because of one of those specific events, those covered perils like fire or theft.
Correct. If a covered peril damages or destroys your personal property, this is the part of the policy that helps pay to repair it or replace it. But here's something really interesting, something that catches a lot of people by surprise. This personal property coverage, it typically extends beyond the four walls of your apartment.
Wait, really? So if I'm out somewhere and not even home, my renter's insurance might still cover my things?
According to the sources, yes. A classic example is if stuff gets stolen from your car. Whether your car is parked right outside your building or you're miles away downtown, your renter's insurance, personal property coverage, can often step in there, especially if your auto insurance doesn't cover personal items inside, or if the items weren't really related to the car itself.
Wow.
Another common situation is if your belongings are damaged or stolen while you're traveling. Maybe your laptop gets lifted from your hotel room, or your luggage gets damaged by the airline. Your renter's policy might actually provide coverage for those items, even when they're far away from your actual rental unit.
That's incredibly valuable. I had no idea. It means the protection isn't just tied to my mailing address.
Exactly. It's protection for your stuff, pretty much wherever it happens to be, within the policy limits, and for covered events, of course.
Okay.
The sources also mention it can sometimes even cover property belonging to friends or family if they've temporarily left something at your place.
Get out, really?
Yeah, so if a friend leaves their expensive camera bag at your apartment while visiting, and then your place gets broken into and the bag is stolen, your policy might actually cover their loss, again, assuming theft is a covered peril.
Okay, that's a major benefit most people probably don't realize they have. But on the flip side, there must be things that aren't covered under personal property, even if I own them.
Oh, absolutely. There are definitely key exclusions you need to be aware of. Like we said, the physical building itself is out. That's the landlord's job.
Right.
Anything owned by the landlord, naturally, isn't covered by your policy. Same goes for property owned by roommates, unless they're specifically named on your policy, which, honestly, they should probably just get their own policy anyway.
Good point.
And it doesn't cover temporary tenants. Like if you had an Airbnb guest staying with you, their stuff isn't covered by your policy.
Okay. What about cars?
Cars, motorcycles, boats, any motorized vehicles, those are excluded. They need their own separate auto insurance or vehicle insurance policies.
Makes sense. What about pets? My dog feels like property sometimes, especially at the vet.
I get it. But unfortunately, pets themselves are not considered personal property for insurance purposes. So your policy won't cover them if they're lost, stolen, or injured under this part of the coverage.
Okay.
And maybe even more importantly for renters, damage caused by your pets inside your apartment. Like if your dog chews up the carpet or your cat shreds the curtains, that's also typically excluded from personal property coverage.
No, okay. Good to know. What else is usually out?
Pests. Things like termite infestations, bed bugs, rodents. The policy won't cover damage they cause, nor will it pay for extermination costs. That's generally considered a maintenance issue.
Right. And I think I saw something weird about drones in one source.
Yeah, that's another one of those specific exclusions that really shows you need to read the details. Personal drones are often explicitly excluded from standard personal property coverage. Although, interestingly, one source did point out that a few states, like New York, California, and Virginia, actually have rules that require insurers to cover drones up to a certain amount. It's a niche example, but it really highlights how policy details and even state laws can make a difference.
Definitely. Okay, so pillar one. Protects my stuff, often even outside the home. But watch out for those exclusions like vehicles, pets, pests, and sometimes drones. What's pillar number two?
Pillar two is personal liability coverage.
Right.
This is arguably just as important, if not more so for some people. It provides crucial protection against potentially massive lawsuits. And like we mentioned, it's often the main reason landlords insist you have renter's insurance.
Okay, what exactly does personal liability cover me for?
Its main job is to protect your finances if you are found legally responsible, meaning like negligent for causing bodily injury to someone else or for causing damage to someone else's property. And that incident has to happen either at your rental property or be caused by your actions related to your place.
Okay, can you give me some real-world examples? Like, how would this actually play out?
Sure. The most common one you hear about, and it's in our sources, is a guest visits your apartment, they slip on a wet spot you forgot to clean up, or trip over a rug, and they get hurt. Badly hurt, maybe.
Okay.
If they sue you, claiming you were negligent, your liability coverage would step in. It helps pay for their medical bills, your legal defense costs, which can be huge even if you win, and any settlement or court judgment awarded against you up to your policy's limit.
Wow.
It also usually includes a smaller amount, often called medical payments to others, which can cover minor medical bills for someone injured at your place, regardless of whether you were actually at fault. It's kind of a goodwill gesture that can sometimes help avoid a bigger lawsuit altogether.
That's smart. What about damaging someone else's property?
Another key example. Let's say you accidentally leave the kitchen sink running, and it overflows and floods the apartment below yours.
Oh, no.
Your liability coverage could help pay for the damage caused to your neighbor's furniture, electronics, rugs, whatever got ruined. And potentially, it could even cover damage to the building structure itself if the landlord comes after you for those repairs too.
Man, that sounds like incredibly important coverage. I mean, a serious injury or major property damage, that could easily run into tens, even hundreds of thousands of dollars in bills and legal fees.
It really, really could.
Okay.
Without this liability coverage, those costs would come straight out of your own pocket, your savings, your future earnings. It could be financially devastating. It's this layer of protection that stops a simple accident from turning into a life-altering financial disaster.
Okay. Liability is crucial. Got it. What's the third core pillar then?
The third one is additional living expenses, or ALE. You'll often see it called loss of use coverage as well.
And this is the one that helps if I actually have to move out because my place is damaged.
Exactly. Its whole purpose is to give you financial support if your rental unit becomes uninhabitable, meaning you just can't live there safely because of a covered loss. Think a serious fire, really bad storm damage, maybe that extensive water damage we talked about. If the damage is bad enough that you're forced to move out temporarily while they make repairs, this coverage kicks in.
What kind of costs does it actually help pay for?
It helps pay for the necessary and reasonable increase in your living expenses while you're displaced. The big one is temporary accommodation, paying for hotel stays, or maybe renting a temporary apartment or house if the repairs will take a while.
Okay.
But it can also cover other extra costs you wouldn't normally have. Things like maybe higher food costs because you can't cook at home and have to eat out more, laundry expenses if your temporary place doesn't have a washer dryer, maybe even pet boarding fees if your hotel doesn't allow pets.
That seems absolutely essential. I mean, being suddenly kicked out of your home, having to scramble for a hotel or a temporary rental, paying for that on top of your regular rent, while also dealing with the stress of the damage. That sounds like a complete nightmare without this ALE coverage.
It is an absolute nightmare without it. The cost of temporary housing, especially if repairs drag on for weeks or months, can add up incredibly fast. It often costs way more than your normal monthly rent. This coverage stops you from having to drain your savings to cover that huge unexpected financial shock.
Right?
It lets you focus on finding a safe place to stay and dealing with everything else instead of constantly worrying about how you're going to pay for the hotel room. It ensures you can maintain some semblance of normal life while your home gets fixed or you find a new permanent place.
Okay, so the 3 pillars are personal property for my stuff, personal liability if I'm responsible for injury or damage, and additional living expenses if I get displaced. That makes sense. Now, let's dig a bit deeper into how the policy decides what specific damage is covered. This brings us back to those perils and different policy types, right?
Exactly. When we're talking about personal property coverage, most standard renters policies you'll find operate on what's called a named perils basis.
Named perils, okay.
It means exactly what it sounds like.
Uh-huh.
The policy will only cover damage or loss if it's caused by one of the specific events or perils that are explicitly listed or named right there in the policy document.
So that list is everything. If the cause of the damage isn't on that list, I'm out of luck.
That is precisely the critical takeaway with named perils policies. You absolutely have to look at that list of covered perils and, just as importantly, understand what's not on the list.
Okay. What's typically on the list? What are the common named perils?
Well, our sources show a pretty standard list that's almost always included. Things like fire or lightning, windstorm or hail, smoke damage, vandalism or malicious mischief, theft, freezing of plumbing, heating, AC systems, or appliances. That's a big one in colder climates. Damage from aircraft or vehicles hitting the building. Riots or civil commotion. Volcanic eruption may be less common for most people.
Hopefully.
Falling objects, like a big tree branch. And then there are a couple related to water. Sudden and accidental tearing apart, cracking, burning, or bulging of a steam or hot water system or appliance. And crucially, sudden and accidental discharge or overflow of water or steam from plumbing, heating, AC, or sprinkler systems.
That sudden and accidental part seems important for water damage.
Very important. Slow leaks or seepages over time are often excluded. It usually has to be a sudden event like a pipe bursting.
Got it. So that's a pretty broad list, but the flip side is just as crucial, knowing the exclusions.
Exactly. If your damage is caused by something not on that list or something that's specifically listed as an exclusion elsewhere in the policy, then a named perils policy won't cover it. That's why reading the fine print, especially the exclusion section, is absolutely vital. You need to know what you're not protected against.
Okay, so named perils is the standard, often called a broad form policy. Are there other options?
It's less common for renters insurance, but sometimes you might see or be offered a comprehensive form or all risks policy for your personal property coverage.
All risks. That sounds better.
Well, it takes the opposite approach. Instead of listing only what is covered, an all risks or comprehensive policy typically covers damage from any peril or cause of loss unless it is specifically listed as an exclusion in the policy.
Ah, okay. So it flips the burden. It covers everything except the things listed as not covered.
Pretty much, yes.
Yeah.
It generally does offer broader protection because it covers a potentially wider range of random, unexpected events that might not be on a named perils list.
But I'm guessing it costs more.
Usually, yes. Because the potential range of covered incidents is wider, a comprehensive form policy typically comes with a higher premium than a standard named perils policy, assuming everything else is equal.
Does where I live matter in choosing between named perils and comprehensive?
It definitely could. If you live somewhere with specific, unusual risks that might not be covered under typical named perils, maybe certain types of non-wind weather events, or you just want the absolute maximum protection possible for peace of mind, then a comprehensive form might be worth looking into, even if it costs a bit more. You need to weigh the risks in your area against the extra cost.
Are there any really major types of damage that are pretty much always excluded from any standard renter's policy, whether it's named perils or comprehensive? Things everyone needs to know about.
Yes, absolutely.
Yeah.
And this is probably the single most critical exclusion to understand because it causes so much confusion and can lead to devastating uncovered losses.
Flooding.
Flooding, okay. Standard renter's insurance policies, just like standard homeowners policies, generally do not cover damage caused by flooding. And that includes different types of floods like rivers overflowing, coastal storm surge, or even water backing up through sewers or drains into your ground level apartment. None of that is typically covered by standard renter's insurance.
So if I live near the coast or near a river or even just in a low-lying area that could flood during heavy rain.
If you live anywhere with any real risk of flooding, you absolutely need to look into getting a separate flood insurance policy. For renters, you'd buy what's called a contents-only flood insurance policy.
Contents only.
Yeah, because you don't own the building. This policy is specifically designed just to cover your personal belongings against damage from flooding. You usually get these policies either through the National Flood Insurance Program, the NFIP, or sometimes through private insurance companies. It's a completely separate policy and a separate cost, but essential if you're in a flood zone.
That is a really, really vital distinction. Okay. Now, I also saw something mentioned in the sources about something called a property damage liability waiver, or PDLW. That sounds confusingly similar to renter's insurance, but you're saying it's not the same thing at all.
Absolutely not the same thing. And this is another huge point of confusion where tenants can get tripped up thinking they have coverage when they really don't.
Yeah.
Some landlords might offer or even require tenants to pay a monthly fee for a PDLW, sometimes rolled right into the rent.
Okay.
It is crucial, absolutely crucial, to understand that a PDLW is not renter's insurance. It provides zero coverage for your personal belongings. None.
Wow. Okay, so what does it do then? Why would a landlord require it?
A PDLW typically only covers accidental damage that you, the tenant, might cause to the landlord's property, meaning the building itself. And often, it only covers damage from very specific events, like maybe fire, smoke, explosion, or sudden water discharge like a sprinkler going off.
So it protects the landlord from me for certain things?
Essentially, yes. It's often structured as a waiver, where the landlord agrees not to hold you responsible up to a certain limit for accidental damage you cause to their building from those specific perils. It's primarily for the landlord's benefit, protecting their structure. It does absolutely nothing for your furniture, your electronics, your clothes, and it does nothing for your personal liability if a guest gets injured.
So even if my lease requires me to pay for a PDLW?
You still need your own separate comprehensive renter's insurance policy to protect your stuff and cover your liability. They are fundamentally different things. Do not let a PDLW fee lull you into a false sense of security.
That is an incredibly important warning.
Okay.
Let's shift gears a bit. Say something does happen, a covered event, and my stuff gets damaged. How does the insurance company actually figure out how much money I get back? This is where ACV versus RCV comes in, right?
Yes, exactly. Actual cash value, ACV, and replacement cost value, RCV. These are the two main ways insurers calculate how much to pay you for your damaged or destroyed personal property. Understanding the difference is really key because it dramatically affects the payout you actually receive.
Okay, let's break down ACV first, actual cash value.
Actual cash value means the insurance company pays you the value of the item at the moment it was damaged or destroyed. So they calculate this by figuring out what it would cost to replace the item today with a similar new one, and then they subtract depreciation.
Depreciation, like wear and tear.
Exactly. Wear and tear, age, obsolescence. How much value the item has lost simply by being used over time.
So let's use that laptop example. If I bought a laptop 5 years ago for, say, $1,000 and it gets fried in a fire today, it's obviously not worth $1,000 anymore, right? Because it's old and used.
Precisely. An ACV policy would look at what that 5-year-old laptop was actually worth in the used market right before the fire. Maybe, $300 or $400. The policy would pay you that depreciated value, that $300 or $400 minus your deductible, of course.
So the result is I get a check, but it's probably not nearly enough to go out and buy a brand new equivalent laptop today. I'd have to chip in a bunch of my own money.
That's exactly the outcome with ACV. You get a reduced amount, and you have to cover the difference yourself to replace the item with a new one.
Okay, that definitely sounds like it could leave you short, especially if a lot of stuff was damaged. How is RCV different? Replacement cost value.
RCV, or replacement cost value, is designed to reimburse you for the actual cost to replace your lost or damaged item with a brand new one of similar kind and quality purchased today.
Ah, okay. So using the same laptop example, if a comparable new laptop today costs, say, $1,200.
An RCV policy aims to pay you that $1,200 minus your deductible, enough money for you to actually go out and buy that new equivalent laptop.
So under RCV, I get enough cash to actually replace what I lost with something new.
That's the goal, yes. The outcome is you receive enough money to fully replace the item without having to dig into your own savings to make up the difference caused by depreciation.
That definitely sounds like the better deal if you actually want to, get back on your feet after a loss.
From a payout perspective, it generally is much better, yes. But, as always, there's a trade-off.
The cost.
The cost. RCV policies almost always cost more in premiums than ACV policies, assuming all the other coverage limits and deductibles are the same. You're essentially paying a bit more each month or year for that guarantee of getting a larger payout if you have a claim.
Do standard renters policies usually come with ACV or RCV?
Standard policies often default to ACV because it keeps the base price lower. However, RCV coverage is usually available as an optional upgrade or add-on. Often the increase in premium for RCV isn't huge, maybe just a few extra dollars a month, and many experts strongly recommend opting for it if you can afford it. It's definitely something to ask about and compare when getting quotes.
Good advice. Now, what about those really valuable things we touched on, like expensive jewelry, maybe some artwork, collectibles, or specialized gear like a fancy camera? Are those fully covered under my main personal property limit, even if I have RCV?
Usually not, unfortunately. This is another common pitfall. Standard renters insurance policies, whether ACV or RCV, often have sublimits on certain categories of high-value personal property. This is especially true for losses caused by theft.
Sublimits, what does that mean exactly?
A sublimit is a maximum dollar amount that the insurance company will pay for all items combined within a specific category, regardless of your overall personal property coverage limit.
Okay, can you give me an example?
Sure. A very common one mentioned in the sources is jewelry theft. Your policy might have an overall personal property limit of, say, $30,000, but it might also have a specific sublimit for jewelry theft of only $1,500 or maybe $2,500. So if someone breaks in and steals your jewelry collection that's actually worth $10,000, even though you have $30,000 in total coverage, the policy will only pay out a maximum of $1,500 or $2,500, whatever the sublimit is, for that stolen jewelry, minus your deductible.
Wow. So even with a decent overall policy, I'd still be out $7,500 or more just on the jewelry.
Exactly. The sublimit caps the payout for that specific category. And these sublimits often apply to other things too, like firearms, silverware, furs, sometimes business property kept at home, or even certain electronics or collections.
That's a massive potential gap if you own anything valuable in those categories. So how do you make sure those specific expensive items are fully protected?
This is where you need to add something extra to your policy. It's usually called a rider or an endorsement or sometimes scheduled personal property coverage. Some insurance companies might just call it extra coverage for specific items.
Scheduled personal property. Okay, what does that involve?
It involves specifically listing or scheduling individual high-value items on your policy. You'll typically need to provide a detailed description of the item, maybe a serial number, and often a recent appraisal or receipt to establish its value. You list each valuable item separately.
And what are the advantages of doing that, of scheduling an item?
The main advantage is that it ensures the scheduled item is covered for its full appraised value, effectively bypassing those low standard sublimits for that specific piece. So if you schedule your $10,000 jewelry collection, you'll have coverage up to that $10,000 amount if it's stolen, less any applicable deductible for the rider, which might be different.
Okay, so it gets you the full value covered. Anything else?
Yes, often scheduling provides broader coverage for that specific item too. It might cover risks that aren't included in your standard named perils policy, like accidental damage, say you accidentally drop your expensive camera and break it.
Oh, wow.
Or even something called mysterious disappearance, meaning the item just vanishes and you honestly don't know if it was lost or stolen. A standard policy usually won't cover that, but a scheduled property rider often does.
That's amazing coverage for valuable things.
And here's another potential kicker. For scheduled items, some insurers might even offer a zero deductible or a much lower deductible than your main policy deductible. So if that scheduled item is lost or damaged, you might get the full value back without paying anything out of pocket first.
That is a huge benefit for things that are irreplaceable or just really expensive. So the bottom line is, Take that inventory, identify your high-value stuff, check your policy's sublimits, and then schedule anything important that exceeds those limits.
Absolutely crucial. Don't just assume your $5,000 watch or your $10,000 artwork is fully covered under the basic policy limit. You almost certainly need to schedule it.
All right, let's finally talk dollars and cents. We've covered the why and the what, but what does renter's insurance actually cost? You hinted earlier that this is where people are often pleasantly surprised.
They really, really are. I mean, compared to what you pay for homeowner's insurance or even car insurance, renter's insurance is remarkably affordable. It provides a huge amount of financial protection for what is usually a pretty minimal expense.
Okay, how affordable are we talking? Ballpark figures.
Well, based on the sources we looked at, the average cost for renter's insurance across the U.S. is hovering around $23 a month right now, as of 2025.
$23 a month.
Yeah. But the typical range you'll often see quoted is somewhere between maybe $15 and $30 a month. And yes, depending on where you live and how much coverage you get, some policies can start even lower. One insurer in the sources actually cited prices starting as low as $5 a month.
$5 a month. That's less than like one fancy coffee or a streaming service subscription.
Exactly. As one source put it, it's often just a few $100s a year for coverage that could potentially save you from tens or even hundreds of thousands of dollars in losses if something bad happens or if you face a liability lawsuit.
That really puts it in perspective.
Right.
It's a tiny investment for potentially massive peace of mind and financial security.
It truly is.
But like any insurance, the exact price I pay can vary based on my situation, right? What are the main things that influence my specific rate?
Absolutely. Several factors come into play. A big one is your location. Where you live matters a lot. Not just the state or the city, but sometimes even your specific neighborhood.
How so?
Well, areas with higher statistical risks generally have higher premiums. Think coastal areas prone to hurricanes or severe windstorms. Areas with higher crime rates, meaning more risk of burglary or vandalism. Even how close you are to a fire station or a fire hydrant can make a difference. Being further away might slightly increase your fire risk and therefore your premium. Conversely, living close to a fire station or in a very low crime area might help lower your cost.
Okay, location makes sense. What's another big factor affecting the price?
Your deductible. We touched on this earlier. The deductible is the amount of money you agree to pay out of your own pocket on a claim before the insurance coverage starts paying.
And the general rule is, if I choose a higher deductible, my premium goes down.
Correct. If you opt for a higher deductible, say $1,000 instead of $500, you're taking on more of the initial financial risk yourself if you have a claim. Because you're taking more risk, the insurance company charges you less for the policy, meaning a lower monthly or annual premium.
And vice versa. Lower deductible means higher premium.
Exactly. If you choose a lower deductible, like $250 or $500, the insurer is on the hook for covering more of the loss sooner, so they charge you a higher premium for that lower risk threshold.
How much can choosing a higher deductible actually save you? Is it significant?
It can be pretty significant. One of the sources estimated that going from a $500 deductible to a $1,000 deductible could potentially save you as much as 25% on your renter's insurance premium.
Wow, 25%. That's a lot.
It is. But, and this is a big, but you have to be absolutely sure you're comfortable getting that higher deductible amount out of pocket if you need to make a claim. Don't choose a $1,000 deductible just to save money if you don't actually have $1,000 readily available in an emergency fund. You need to be able to cover that deductible to even start the replacement or repair process. Common deductible choices are usually $500 or $1,000.
Good point. Choose a deductible you can realistically afford to pay. What about my personal history with insurance claims? Does that matter?
Yes, your claims history definitely plays a role. If you've filed multiple insurance claims in the recent past, usually the last 3 to 5 years, insurers might see you as statistically more likely to file claims in the future, and they may charge you a higher premium as a result. On the other hand, having a claims-free history for several years can often earn you a discount.
Okay. And what about credit history? I hear that sometimes affects insurance rates. Is that true for renter's insurance?
In many states, yes, it can be. This is a bit controversial, and some states have regulations limiting or prohibiting its use. But where it's allowed, insurance companies often use what's called a credit-based insurance score.
Why? What does my credit have to do with insurance risk?
Well, insurance industry studies have shown a statistical correlation, not necessarily causation, but a correlation between certain credit characteristics and the likelihood of filing insurance claims. So, generally speaking, in states where it's used, a lower credit score might lead to a higher insurance premium, while having good credit can help lower your rate.
Interesting. And obviously the amount of coverage I choose must affect the price too.
Oh, for sure. That's a direct relationship. The higher the coverage limits you select, the higher your premium will be. So if you choose $30,000 in personal property coverage instead of $15,000, your premium will go up. If you choose $300,000 in liability coverage instead of the minimum $100,000, your premium will go up. Same for higher limits on additional living expenses. You need to select limits that truly cover your assets and potential risks, but just be aware that higher limits mean higher costs.
Okay, so even though renter's insurance is already pretty affordable, are there ways to make it even cheaper? Are discounts common?
Definitely. This is something you should always ask about when getting quotes. Insurance companies offer a variety of discounts that can potentially lower your premium.
Like what? What are some common ones?
One of the biggest and most common ones mentioned in our sources is bundling policies. If you already have car insurance, getting your renter's insurance from the same company or the other way around usually qualifies you for a multi-policy discount, often saving you money on both policies.
That's a classic one. Always worth checking. What else?
Discounts for having certain security devices in your rental unit. This could be a professionally monitored burglar alarm system, maybe a central station fire alarm that automatically calls the fire department. Sometimes even just having deadbolt locks on all your exterior doors, or having working smoke detectors installed where required can get you a small discount. Sprinkler systems too, if your building has them.
Okay, safety features pay off.
Yep. Also, that claims-free history we mentioned earlier. If you haven't filed any claims for, say, the last 3 or 5 years, you might get a discount for that. Some insurers offer discounts based on age, like a discount for people over 55. And sometimes, just being a loyal customer and staying with the same insurer for several years can earn you a loyalty discount.
So, bottom line, it really pays to ask the agent or the company rep about every single possible discount you might qualify for when you're getting quotes or even when reviewing your existing policy at renewal.
Absolutely. Don't assume they'll automatically apply everything. Ask specifically about bundling, security devices, claims history, age, loyalty. Yeah. Anything you can think of. You might already have some of these things, but they might be easy to implement, and they could shave a noticeable amount off your annual cost. Don't leave that money on the table.
Great advice. Okay, so we've hammered home the necessity, we've dissected the coverage, we've looked at the costs and the factors influencing price, and how to get discounts. Now, let's talk about the process of actually getting the right policy. How do you navigate that? And maybe more importantly, what are the big mistakes people commonly make that you really need to avoid?
Okay, the absolute first and arguably most critical step in getting the right policy is to shop around. Don't just take the first quote you get, even if it seems cheap or it's from a company you recognize.
Get multiple quotes.
Yes. Get quotes from several different insurance providers. Check out the big national companies. Look at some regional insurers that operate in your state, and maybe even talk to an independent insurance agent who can get quotes for you from multiple different companies they work with.
And when you have those different quotes in hand, what's the key to comparing them fairly?
You absolutely must compare apples to apples. This is crucial. Make sure you are looking at policies that offer the same fundamental levels of coverage.
Well, no.
Meaning, are they both offering actual cash value, ACV, or are they both offering replacement cost value, RCV, for your personal property? That's a huge difference right there. Are the dollar limits for personal property coverage the same in both quotes, say $20,000 or $30,000? Are the liability coverage limits the same, maybe $100,000 or $300,000? And is the deductible amount the same? You can't fairly compare the price of a policy with $20,000 ACV coverage and a $1,000 deductible to one offering $30,000 RCV coverage with a $500 deductible. The prices will be different because the protection is vastly different.
Right. So don't just jump at the lowest number on the page.
Absolutely not. And that leads directly into one of the biggest mistakes the sources warn against: choosing the cheapest policy without making sure it has adequate coverage.
Yeah, the temptation is strong.
It really is. While the affordability of renter's insurance is fantastic, just blindly picking the absolute cheapest option might mean you're getting rock-bottom coverage limits that don't actually cover the value of your stuff, or maybe a policy with tons of exclusions, or a really high deductible that you wouldn't be able to afford if you had a claim. The goal isn't just the cheapest policy, it's the best value getting the protection you actually need at a competitive price.
Beyond just the coverage details and the price tag, Should you also think about the insurance company itself, like their reputation?
Oh, definitely. You should absolutely check the insurance company's reputation. Look into their financial stability. You can check ratings from agencies like AM Best, which assess insurers' financial health. But maybe even more importantly for you as a policyholder, look into their reputation for handling claims.
How you do that?
Ask around. Talk to friends or neighbors who might have experience with them. Check online reviews, although take those with a grain of salt sometimes. Look at consumer reports or state insurance department complaint ratios if available. One source even had a great suggestion. Ask local restoration companies, the folks who actually do the cleanup and repairs after fires or floods. They deal with insurance adjusters all the time and often have a good sense of which companies are fair and responsive and which ones tend to drag their feet or lowball claims.
That's a clever inside tip. Now, can you just get quotes and buy a policy entirely online these days, or is it still better to talk to a human agent?
You absolutely can get quotes and purchase policies online or over the phone directly from many insurance companies. It's fast and convenient. However, especially if you're new to renter's insurance or if your situation's a little more complex, maybe you own those high-value items we talked about, or you run a small business from home working with a licensed insurance agent, can be really beneficial.
How so?
As one source, actually a Reddit user sharing their experience, pointed out, a good agent can really take the time to explain the different coverage options in plain English, clarify what's excluded, help you figure out how much coverage you actually need based on your belongings and risks, and just generally make sure you understand what you're buying. They can help tailor the policy to fit you, not just sell you a generic package.
That sounds valuable. And how can you protect yourself from, scams or dealing with companies that aren't even legitimate?
That's a really important point. A key safeguard is to verify authorization. Before you sign anything or give out payment information, take a minute to check with your state's Department of Insurance.
What should you check?
Confirm that both the insurance company itself and the specific agent you might be working with are properly licensed and authorized to sell insurance in your state. Every state insurance department has a website or a phone number where you can usually do this lookup easily. One source used the Maryland Insurance Administration as an example, but they all offer this service. It's a quick check that gives you peace of mind knowing you're dealing with a legitimate, regulated entity.
Okay, good safety tip. Let's really hammer home those other crucial mistakes people make, the ones highlighted in the sources. What's maybe the #1 error renters make when getting insurance?
We touched on it, but it bears repeating because it's so common. Underestimating the value of your belongings. Seriously, most people have no idea how much stuff they actually own or what it would cost to replace it all at once.
They think about the TV and the couch, maybe.
Exactly. They think about the big things, but they completely forget the cumulative value of everything else. All the clothes, shoes, coats in the closet, everything in the kitchen drawers and cabinets, all the linens, towels, books, decorations, lamps, rugs. It adds up incredibly fast.
So the solution is?
You have to take inventory. It's non-negotiable if you want the right coverage. Go room by room. Open every drawer, every closet. Make a list. Better yet, take photos or shoot a video walking through your place, narrating what you have. Use a spreadsheet. Use a dedicated home inventory app. The National Association of Insurance Commissioners, NAIC, actually has a free one, or just use a paper notebook. Document everything you can.
And this helps you figure out how much coverage to buy.
Precisely. Once you have that inventory, you can start putting replacement cost estimates next to items, and you'll get a much more realistic idea of the total value you need to insure under your personal property coverage. It's almost always significantly higher than your initial guess. And honestly, it's better to be slightly overinsured than significantly underinsured when disaster strikes.
Makes total sense. Okay, what's another major mistake?
Neglecting liability coverage. This is a big one too. Some people get so focused on protecting their physical stuff that they might choose the lowest possible liability limit offered, maybe just $100,000, or even look for policies with minimal liability just to save a few bucks on the premium.
Why is that risky?
It's incredibly risky because while losing your stuff is bad, a serious liability lawsuit could be financially catastrophic in a way that losing possessions rarely is. If a guest has a major injury at your place and sues you, or if you accidentally cause a fire that damages multiple apartments, the potential judgments against you could easily reach hundreds of thousands, even millions of dollars, far exceeding the value of all your belongings combined.
And the cost to get higher liability limits usually isn't that much more, right?
Exactly. The difference in premium to go from, say, $100,000 in liability to $300,000 or even $500,000 is often surprisingly small, just a few extra dollars a month. But that added protection provides immense financial security. Don't skimp on liability coverage. It's your shield against potentially ruinous lawsuits.
Okay, don't underestimate my stuff. Don't skimp on liability.
Yeah.
We've also stressed reading the fine print, but it's worth calling out as a mistake, too.
Oh, absolutely. Not understanding policy exclusions.
Yeah.
So many people buy a policy, maybe glance at the declarations page showing the limits, and then just file it away. They only pull it out and try to figure it out after something bad has happened.
And then?
And then they might get a nasty surprise when they discover that the specific cause of your loss, maybe it was a flood, which we know needs separate insurance, or an earthquake, often excluded, or mold damage that wasn't directly caused by a sudden covered water leak, or damage from pests was actually listed as an exclusion in the policy. Or they find out about those low sublimits on their stolen jewelry after the theft.
So the advice is read the policy before you need it.
Read the policy. Pay special attention to the section labeled exclusions. And if there is anything in there or anywhere else in the policy that you don't understand, ask your agent or call the insurance company before you finalize the purchase or at renewal time. Get clarification. Knowing what is not covered is just as important as knowing what is. Don't wait until you have a claim to find out.
Good advice. And relate it to that for those special items.
Right. Skipping additional coverage for high-value items. We covered this with sublimits and scheduling, but it's a common enough mistake to highlight again. If you own valuable jewelry, artwork, antiques, firearms, high-end cameras or computers, expensive musical instruments, or significant collections, do not assume they're adequately covered for their full value under your standard personal property limit. Check those sublimits carefully, get appraisals if necessary, and schedule those items properly with a writer or endorsement. It's the only way to ensure they're fully protected, and you might get broader coverage and better deductible terms for them too.
Okay. What about that coverage that helps if you're displaced?
Yes, another common oversight. Overlooking loss of use coverage or additional living expenses, ALE. Make sure your policy actually includes this coverage and check that the limit is adequate. Think about how much it would realistically cost per day or per month for a hotel or temporary rental in your area, plus extra food costs if you were forced out of your apartment for, say, several weeks or even months while repairs were being done after a fire or major water damage. Without enough ALE coverage, those displacement costs can drain your savings very quickly. Make sure the limit seems reasonable for your location and potential duration of displacement.
And insurance isn't just a set-it-and-forget-it thing, is it?
Definitely not. Another mistake is not updating your policy regularly. Your life changes over time, and your insurance needs change too.
Like what kind of changes?
Did you buy a lot of new expensive furniture or electronics since you first got the policy? Did you inherit some valuable jewelry or artwork? Did you get married or have a domestic partner move in? A spouse is usually automatically covered, but a partner might need to be specifically added. Did you get a roommate? They need their own policy, but it might affect your situation. Critically, did you move to a new rental property? Your coverage needs to reflect your current lifestyle, the current value of your possessions, and your current address and associated risks. Review your policy at least once a year, and definitely whenever there's a major life change. Make sure your coverage keeps pace.
And we already mentioned discounts, but ignoring them is a mistake too.
It's such an easy mistake to make, but yes, ignoring available discounts. Don't just accept the first premium quoted. Actively ask your insurer or agent about every single discount we talked about. Bundling, security systems, fire safety features, claims-free history, age loyalty programs. Take a few minutes to see what you qualify for. It's free money, basically.
And finally, just to reinforce that point about price versus protection.
Yeah, that mistake of choosing the cheapest policy without adequate coverage really is worth repeating because the temptation of that low price tag is so strong. But remember why you're buying insurance in the first place. It's to transfer potentially catastrophic financial risk away from yourself, paying a slightly higher premium to get RCV instead of ACV, or to get higher liability limits, or to have a deductible you can actually afford to pay, could be the difference between smoothly recovering from a disaster and facing severe financial hardship. Evaluate the coverage you need first, make sure the policy provides it, then compare prices for that adequate level of coverage across different insurers. Don't let price be the only factor. Maybe aim for at least a $500 deductible. Consider $1,000 if you can comfortably afford it and want the premium savings, but make sure that amount is accessible in your emergency fund.
Excellent summary of pitfalls to avoid. Okay, so let's imagine the worst has happened. Despite your best efforts, disaster strikes a fire, a break-in, major water damage. You've done your homework, you have the right policy. Now what? How do you actually file a claim and navigate that process as smoothly as possible?
Okay, yeah, the sources provide a pretty clear roadmap for what to do when you actually need to use the insurance. Organization and communication are definitely key here. First step, and this is critical for certain types of losses. Report the incident to the authorities, if it's appropriate.
Meaning, call the police or fire department? When would I do that?
If the damage was caused by a crime like a burglary, theft, or vandalism, you absolutely need to file a police report. If there was a fire, obviously the fire department would be involved. You need to contact them immediately after ensuring everyone is safe.
Why is that important for the insurance claim itself?
You will almost certainly need a copy of their official report to submit with your insurance claim. It provides an objective, third-party documented account of what happened, when, and what the initial findings were. It's really valuable supporting evidence for your loss. So always get a copy of the police report or fire report number. Now, obviously, for something like a simple leaky pipe, you wouldn't normally call 911 unless there was an immediate major safety hazard like electrical sparking.
Okay, so call authorities if it's a crime or major event. What's the very next step?
Contact your insurance company or your agent as soon as you possibly can after the incident. Don't delay. Most insurance policies actually require you to report a loss promptly or within a certain time frame, sometimes as short as 24 hours, or maybe just as soon as reasonably practicable.
What should I have ready when I call?
Have your policy number handy if you can find it easily. Be prepared to give them the basic details. What happened, when it happened, where it happened, and a general idea of the type of damage or loss. It's also a really good idea to keep a log of this conversation, jot down the date, the time you called, and the name of the person you spoke with at the insurance company. Documentation is your friend throughout this process.
Okay, I've notified the insurance company, then the formal paperwork starts.
Yes, they will likely send you or direct you online to a claims form to complete. This is often called a proof of loss form. You'll need to provide all the detailed information about the incident, the date, time, cause of loss, and importantly, a list of the property that was damaged or stolen. Be as thorough and accurate as you possibly can. For simpler, smaller claims, submitting this form along with your documentation might be enough. For larger or more complicated losses, the insurance company will assign a claims adjuster to your case.
A claims adjuster, what do they do?
The adjuster is the person from the insurance company who will investigate your claim. They'll likely contact you, maybe schedule a time to come inspect the damage at your rental unit, review your documentation, ask questions, and ultimately determine the extent of the covered loss and the amount the insurance company will pay based on your policy terms, ACV versus RCV, deductibles, limits, etc.
And documentation is key for dealing with the adjuster too, I assume.
Absolutely vital. You need to document the damages thoroughly. And do this before you start any major cleanup or make any permanent repairs other than things needed for immediate safety.
How should I document?
Take lots of clear photographs and videos, get shots of the overall damage to the room or area, and also close-ups of specific damaged items. If you have that home inventory with before pictures or videos that you hopefully made when you got the policy.
Ah, the inventory comes in handy again.
Hugely handy. Being able to show the adjuster, this is what my couch looked like before the fire, and this is what it looks like now, is incredibly helpful for proving the extent of the loss and the quality of the item you need to replace. But even if you don't have before pictures, any documentation of the damage itself is better than nothing.
Okay. What about making repairs? Can I start fixing things right away?
You absolutely should take reasonable steps to make necessary temporary repairs to prevent further damage and to make your home safe and secure if possible. For example, if a window was broken during a storm or break-in, you should cover it with plastic or board it up. If a pipe burst, shut off the water supply to that pipe. If the roof was damaged, maybe put a tarp over the hole to prevent more water from getting in.
Should I keep receipts for those temporary fixes?
Yes. Save all receipts for any materials or labor involved in making those necessary temporary repairs. Your policy may reimburse you for these reasonable costs incurred to mitigate further damage. However, and this is important, do not start making permanent major repairs or doing extensive renovations until the claims adjuster has had a chance to inspect the damage. and you've reached an agreement with the insurance company on the scope of the covered work and the amount of the payout. Don't tear out walls or buy all new furniture before the claim is settled.
Got it. And if I actually can't live in my apartment because of the damage, we talked about ALE coverage. How do I get reimbursed for those hotel bills and extra costs?
If the damage is severe enough that your unit is uninhabitable and you have to move out temporarily, you need to save all your temporary living receipts. Keep meticulous records of everything related to your increased living expenses that fall under your loss of use ALE coverage. Hotel bills, receipts for temporary rental agreements if it's a longer displacement, receipts for meals if you're eating out more because you have no kitchen, laundry receipts, pet boarding fees. Keep everything organized.
And then submit them.
Yes. You'll need to discuss the process with your claims adjuster or your agent. Find out how and when they want you to submit these receipts for reimbursement under your ALE coverage. They might have specific forms or procedures for this.
Okay. And the final tip for navigating the claims process seems to be just stay in touch.
Pretty much. Make yourself available and be responsive. The claims adjuster is managing your case, and they might have follow-up questions, need additional documents from you, like receipts for lost items if you have them, or need to schedule further inspections. Respond to their calls, emails, or letters promptly. The faster and more cooperatively you provide the information they need, generally the smoother and faster the claims process can move towards a resolution and getting you paid.
That all sounds like solid advice, but what happens if, despite doing all that, I run into problems? What if I feel like the insurance company isn't treating me fairly? Maybe they're offering way less money than I think is right, or they're just dragging their feet and delaying payment unreasonably. What recourse do I have?
That's a fair question, because disputes do happen sometimes. If you believe the insurance company is improperly handling your policy or your claim, the very first step should always be to try and resolve it directly with the people involved, your assigned claims adjuster or your insurance agent.
Talk to them first.
Yes. Clearly explain why you disagree with their assessment or decision. Provide any additional documentation you have to support your position. Sometimes it might just be a misunderstanding, a miscalculation, or an oversight on their part that can be corrected through clear communication and providing more information. Give them a chance to review it and respond.
But what if that doesn't work? What if I talk to the adjuster, maybe even their supervisor, and I still feel like they're not being fair or following the policy terms?
If you can't get a satisfactory resolution by working directly with the insurance company representatives, then your next step is to seek assistance from your state's Department of Insurance, DOI.
The state regulators.
Exactly. Every state has a DOI office, sometimes called by a slightly different name, like Department of Banking and Insurance, whose job includes protecting insurance consumers. They can provide information about your rights, help mediate disputes between you and the insurer, investigate formal complaints against insurance companies, and take action if they find the company violated state insurance laws or the terms of the policy contract.
How do I contact them?
Most state DOIs have websites with information on how to file a complaint. Often you can do it online. They also have phone numbers and email addresses you can use. One of the sources used the Louisiana Department of Insurance as an example, mentioning you could file online, call, or email them. The process is generally similar in other states. Your state DOI website is the best place to start to find out how to file a complaint or ask for assistance.
Okay, that's really good to know. There's an official channel for help if things go wrong. So as we start to wrap up this whole deep dive into U.S. renters insurance, it feels like the absolute core message, the really critical takeaway, boils down to this. Yeah, your landlord has insurance, but that policy covers their building, the responsibility for protecting your personal belongings inside that building.
Your stuff.
Shielding your financial future from potentially crippling liability risks.
If someone gets hurt or you cause damage.
And ensuring you have a roof over your head and help with expenses if your place suddenly becomes unlivable because of a fire or other covered disaster. All of that falls squarely, 100% on your shoulders as the renter.
That is the fundamental truth of renting right there.
Yeah.
Your stuff, your liability risk, your temporary shelter. If things go bad, that's your domain. You have to protect it yourself.
And this is the really empowering part of the conversation. I think renters insurance provides exactly that essential multi-layered protection. And as we've discovered, it is probably far, far more affordable than most people realize, often costing less per month than, a couple of fancy coffees or that streaming service you barely watch.
It really is a remarkably cost-effective investment, especially when you weigh that small monthly premium against the potentially devastating financial hit of having to replace everything you own out of pocket after a major fire or theft, or facing down a six-figure liability lawsuit, the value proposition is huge.
And by taking those few proactive steps, we talked about actually doing that inventory.
So important.
Understanding the crucial difference between ACV and RCV.
Opt for RCV if you can.
Checking for those sneaky sublimits and scheduling your valuable items.
Don't get caught short on jewelry or electronics.
Making sure you have adequate liability coverage, not just the bare minimum.
And protect yourself from lawsuits.
Really understanding the policy exclusions before you need to file a claim.
No, it's not covered.
And always asking about every possible discount.
Save that money.
By doing those things, you can make sure you're not just buying a policy, but getting the right protection. Coverage that's actually tailored to your life, your possessions, your risks, and getting it at the best possible price.
It's really an investment in your own financial resilience. It safeguards your present and potentially your future from unexpected shocks.
So let's leave you with this final thought to mull over. If disaster did strike your rental unit tomorrow, a serious fire, a major leak from upstairs that ruins everything, a significant break-in where they take all your electronics, could you truly, honestly afford to lose everything you own and just start over completely from scratch? While also potentially paying for temporary housing out of pocket and maybe even facing liability claims if you were somehow involved, could you handle that financially without any insurance safety net?
That's the hard question.
Taking just a little bit of time today, maybe this afternoon, maybe this weekend, to actually inventory your life's possessions, figure out what they're worth, and explore your renter's insurance options. It means you're taking control, you're putting that financial lifeline in place before you need it, so that hopefully you may never have to face that devastating question as a stark, unbearable reality.